I think the import-export numbers kind of caught them trying to do that. And if that's what they're getting caught with, my guess is there's a whole lot more they're not telling us about in terms of the way that they are very privately accumulating things around the world so that it's not directly a state-sponsored accumulation, but doing so kind of on the sly. And I think that is one of the things that I would take away from 2024 as well. And that is that massive accumulation and trying their best to kind of hide exactly how much they're accumulating and producing, for that matter, as well.
What Andy was talking about, central banks stepping up and creating demand for gold, not so much silver directly, but silver's going to move with gold. So I think that is definitely significant.
China's influence in the global gold market reached new heights in 2024, marked by record prices and complex trading patterns. The nation's dual role as a leading consumer and strategic buyer has significantly impacted market dynamics. The latest data shows that China's net gold imports via Hong Kong more than doubled in November to 33.074 metric tons, a 7-month high, up from 15.414 tons in October. Total imports through Hong Kong reached 45.22 metric tons, marking an 8-month peak with a 60% increase from the previous month. Market analysts Andy Schectman and Bill Holter suggest a disconnect between official reports and actual acquisition patterns. The People's Bank of China, PBOC, officially reported pausing gold purchases for 6 months before resuming in November 2024. However, market analyst Andy Schectman points to a discrepancy between this official stance and actual trade data. Import-export figures suggest continuous gold acquisition activity during the reported pause period, indicating potential unreported purchases. According to market analysis, the PBOC may have acquired over 100 tons of gold through unreported London imports in Q4 2024 alone. The strategic approach extends beyond China. Holter points out that Chinese entities' direct purchases from miners effectively reduce the supply available to traditional market venues like the LBMA and COMEX. Combined with similar strategies by countries like Saudi Arabia and India, this practice creates a more complex picture of global gold flows than official data suggests. Adding to market pressure, Russia's announced focus on silver acquisitions further strains the supply-demand balance of precious metals. These developments highlight a broader trend of major economies quietly strengthening their precious metal positions while maintaining limited transparency in their reporting practices. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
You had China telling us that they took 6 months off from accumulating metals, which really wasn't true. In fact, the import-export numbers showed anything but that, and they were kind of caught. You saw the same thing with Saudi Arabia. Saudi Arabia importing metals that, again, attempted to not be reported to the IMF. And the numbers are far, far, far in excess of what we are being told. I've had numerous confirmations from mining executives that have told me, indeed, that China's flying all around the world, mostly in South America, and buying up doré and concentrate from the miners directly, which is disintermediating the marketplace, and it doesn't get reflected in the price or calculated in terms of how much they're actually buying. And it's not just silver, it's gold as well, although 70+% of the silver they're using in industry is coming from concentrate purchases, where they're buying sludge in excess, in essence, rather, directly from the miners, paying more than the West will, sending it back to China and refining it. And so what we are seeing by all of these countries is a way for them to accumulate metal without it being cataloged or the IMF keeping track of it. And the PBOC is just a very small part of Chinese gold accumulation. The People's Liberation Army is thought to have as much or more as the PBOC because they are not required to report it directly to the IMF. Or, as we were saying with the concentrate of the doré, if metal is purchased that is under the 999 or 995 purity, that's not reported. Or if it's being accumulated by proxy, if you will, by commercial banks on behalf of the PBOC, that's not reported. And the same thing is going on with Saudi Arabia, and the same thing is going on with India. These are very large state-sponsored sovereign wealth funds that aren't reporting it. The thing about what you're mentioning in particular is that the PBOC said we stopped buying gold for 6 months. In essence, they didn't. They just stopped reporting it and tried to hide it much more keenly, if you will.
I do want to add to what Andy was talking about. Absolutely, you've got China trying to buy directly from miners. And that's a huge deal because that means there's going to be less metal that'll make it to refiners and thus less metal available for LBMA and for COMEX. One other thing is that very interesting, back in, I think it was October, Russia announced that they were going to be purchasing other commodities, and the first one they named was silver. And I mean, the supply and demand is on a knife's edge. So you get, additional demand is going to blow up the supply. From a short-term, technical standpoint, we're oversold again. I mean, we've seen multiple times this past year where the metals bottomed. I posted, and I think, Andy, you posted my charts also showing the bottom hooks. And I think what that illustrates is exactly what Andy was talking about, central banks stepping up and creating demand for gold, not so much silver directly, but silver's going to move with gold. So I think that is definitely significant. And I really don't think it's important, if you're wanting to know, should I buy at 29, should I buy at 27.75 or whatever, who knows? And when all is said and done, it's not going to matter. The whole idea is that you're getting your capital out of the system and into something that cannot bankrupt. Because when this whole thing goes down, mark my words, the great taking is very real. And a huge amount of people are going to be left with nothing.
The U.S. federal deficit will expand in 2025, following President-elect Donald Trump's electoral victory. Market analysts point to an impending fiscal policy shift, with planned tax cuts likely to reduce federal revenue, while significant spending reductions face implementation challenges. Financial experts express growing concerns about fiscal stability. Andy Schectman highlights current fiscal year trends as historically problematic, while Bill Holter anticipates a fundamental change in sovereign debt valuation for 2025. Holter suggests markets will begin pricing government bonds based on individual risk profiles rather than relying on uniform central bank rate benchmarks. Reduced tax revenues and continued spending could amplify existing fiscal challenges. With Republicans controlling the White House and Congress, implementing substantial tax cuts appears likely, though promised spending reductions may prove more challenging. This political reality suggests that increased deficit spending may become a defining feature of the 2025 fiscal landscape. Let's get back to the interview.
I think that from a domestic standpoint, I think the debt issue is something that has to be front and center. I mean, even Trump just sent out a tweet the other night saying, thanks to what the Democrats have done, 2025 could be a 1929 style depression. You look at the latest Treasury data that was just released for November, which was the second month of fiscal 2025. The U.S. spent $584 billion for October and November. That's the first 2 months of 2025 for the fiscal calendar year that Trump is inheriting are officially the worst start to a year ever for the Treasury. When I look at gold acquisitions, again, China doesn't buy gold for no reason. And they've bought 1,000 tons since the start. That's what they tell us, since the start of the Ukrainian war. At the same time, they've sold $250 billion of our U.S. treasuries. This is a trend that will continue. This de-dollarization will continue. I think they'll continue to accumulate gold rather than try to devalue their yuan against the dollar. They'll let it happen organically by accumulating gold. I think that's something certainly to focus on. Of course, it's the bond market. At the same time, I think the bond market, or with the Fed creating trillions to fund these deficits, that not only that they're inheriting, but the debt that is coming due. I think the bond market's getting very nervous that they see inflation coming back, that the ballooning U.S. debt is something that has to be dealt with, and how many Treasury securities will have to be created to do so. At the same time, many of the countries that traditionally supported our debt are moving in the other direction. So I think that's something that we'll have to continue to watch very, very closely.
I also believe that 2025 is going to be the year where you're going to see a differential of market rates, not necessarily interest rates that the central banks are using, but how those sovereign treasury bonds are valued. And I think 2025 is going to be the year where there is discernment between credit A, credit B, credit C, based on risk premia, which does not exist. I mean, if there was risk premia that existed, Japan, you would have interest rates at what? 15, 20, 30%. I mean, they're 300% debt to GDP. You'd see the US with higher rates than what we have. So I think this will be the year where sovereign treasuries are looked at based on their metrics, as opposed to they're just another sovereign treasury and everything's fine. So I think that's something that's going to come up. And I also think that because the entire system is a Ponzi scheme, we're really looking at a global debt trap from the standpoint of we've reached debt saturation, and any Ponzi scheme cannot continue unless there's new money that comes in. And the way new money is created is largely by debt. I mean, it's no longer printed like it was during Weimar Germany.
Major players' quiet accumulation of gold and silver and anticipated fiscal shifts in the U.S. highlight the fragility of traditional systems and the rising need for alternative approaches. Investors and policymakers must remain vigilant, adapting to the opaque and ever-changing dynamics shaping these critical markets. What strategies should individuals and nations adopt to navigate the challenges of shifting fiscal policies and evolving precious metals markets? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.